You're probably familiar with the Federal Reserve's dual mandate that has been given to them by Congress, which is to promote maximum employment and price stability. But what most people don't know is that the Federal Reserve actually has a secret third mandate, and that is to promote moderate long-term interest rates. And this third mandate actually supersedes the first two because it supports the real reason behind the Federal Reserve's entire existence. And knowing how this works will help you position your portfolio to be able to profit off of the coming chaos because you know in advance how they're going to deal with it. I'm Joe Brown. I'm a former stockbroker and I run Heresy Financial, where I teach active investors how to decrease portfolio risk and increase long-term returns. Now we've got to take a bit of a trip back in time to the creation of the Federal Reserve because their job today is not exactly what it was when they were started. The Federal Reserve was established in 1913, and its directive by Congress was to furnish an elastic currency to afford means of rediscounting commercial paper and to establish a more effective supervision of banking in the United States. Now, obviously, they did a bang-up job of that because within 7 years of the Federal Reserve's creation, we had the first Great Depression in 1920, and then 9 years later, we had an even bigger depression that we now call the Great Depression, starting in 1929. So I'm really glad we got the Federal Reserve in there to manage bank risk. But in 1946, Congress passed the Employment Act of 1946, which declared that government policy was to promote maximum employment, production, and purchasing power. Moving forward to the 70s, inflation had gotten out of control from abandoning the gold standard, and so the 1977 Reform Act to the Federal Reserve was passed. And here's where they were given their triple mandate to achieve maximum employment, stable prices, and moderate long-term interest rates. So let's go through these one by one, starting with maximum employment. Why in the world would an entity like the Fed, that is essentially just a bank for the rest of the banks, be charged with maximum employment of the entire nation? Well, the reason is because, number one, they can affect employment with monetary policy through manipulation of money, both interest rates and the supply. And this is particularly insidious that the government charged the Fed with this because it is entirely self-serving to the government and not to the people of the United States. You see, employment should be a means to an end, and that end should be wealth. But the government treats jobs as an end in and of itself. Nobody wants a job for the job's own sake. You want a job because of what you are getting from the job, which is usually money, sometimes skills, but ultimately you have a destination in mind. So why would the government treat jobs as an end themselves, making an agency who manipulates money focus on making sure there's as many people as possible with jobs? It's because that is the source of the government's income. Over half of the United States government's total tax revenue comes from individual income taxes, and 37% comes from Social Security and Medicare taxes, which are also individual employment taxes, which means 88% of the United States government's income comes as a result of taxing people who have jobs. And so if you can tell the currency manipulator to manipulate the currency in a way that makes sure that as many people as possible have to have jobs for as long as possible, you're gonna do it because that's where you get 88% of your taxes from. Maximum employment is not for our benefit. It's so they have a constant tax base of people to steal their purchasing power away from for their entire lives. They do not want you to retire. They do not want you to get financially educated. They do not want you to know how to invest. They do not want you to know how to stay out of debt. They want you locked in permanent employment forever so they can tax you forever. But what about stable prices? I'm sure they have benevolent reasons for wanting stable prices, right? Well, in reality, prices should go down over time. And historically, that's what prices did. For all of human history, except for brief periods of time when you have money dilution, you have deflation over time. A great example of this is the period of time from 1870 through 1910. You had deflation, in other words, prices naturally went down over time, and people thrived financially because even though prices were going down, And even though wages were going down, real wealth and real wages kept on going up. In other words, everybody was getting a lot more for less. The cost of acquiring goods and services, in other words, wealth, went down so fast that everybody kept on getting wealthier and wealthier, even though the nominal amount of wealth might have been going down. If that's confusing, imagine you have a salary of $100,000 this year, and next year, your salary goes down to $90,000. But also imagine during that time, the house that you were looking at buying went from $500,000 to $200,000. The car you were looking at buying went from $50,000 to $15,000. That food, that restaurant that you liked eating at, used to cost you $100 for a meal. Now it costs you $40 for a meal. If your cost of living drops significantly, you don't actually care if your income drops a little bit because your money goes so much farther than it did before. That's how things worked for all of human history because the money supply was so constant and was so anchored to reality because you had to mine gold to get more money that as the total pile of wealth grew and there were more goods and services, you had less money chasing more stuff. That's deflation. It's the opposite of what we have today, which is where the money supply grows faster than the pile of goods and services. So you have more money chasing less goods, less stuff. And in fact, in the 1977 Reform Act, the government specifically stated that they wanted the Federal Reserve to maintain a long-run growth of the monetary and credit aggregates commensurate with the economy's long-run potential to increase production. In other words, they didn't want the real stuff, the real wealth, the goods and services to grow at a faster pace than the money supply. They wanted to make sure the printing always exceeded that. So the question is why? Well, this is a chart of real interest rates. Real interest rates are calculated by adjusting whatever the interest rate is for whatever the inflation rate is at the time. And you can see that often real interest rates are actually negative. And by the way, this is treasury yields. So this is what the government is able to borrow at. They want inflation so that they can borrow at negative real interest rates. If I borrow at 1%, but inflation's at 2%, then my real cost of borrowing is negative 1%. In other words, I'm getting paid to borrow because I am borrowing money that is worth more than the money I'm paying back to you in the future. And the increased quantity of dollars that I do have to pay you back in the future are not enough to make up for that fact. Why would the government want negative real interest rates? Well, because the national debt continues to grow. It's not enough that they force as many people as possible into lifelong tax slavery. They want to spend even more than that. And they don't want to actually have to pay for that debt. So they want to borrow at negative interest rates. Now, the fun thing here is that all of this inflation has the added bonus of keeping people employed for longer, because if you just save up wages for 5 years, 10 years, eventually that inflation is gonna start eating away rapidly at all your savings, which means you have to work longer and harder just to keep up with the inflation. And yeah, you'll get a raise and a promotion here and there, but it's rarely going to keep up with or make up for the inflation along the way. The persistence of inflation also means that that money is not usually going to be kept in savings or out of productive work, even though that's a fallacy. That means that people have to deploy that money into investments and into the economy in order to try and get a return that outpaces inflation, even if that means taking on higher risk than they would want to otherwise. This is politically expedient. In other words, it's what the politicians want because in the short run, it feels better because there's artificial booms and they don't care that it might mean there's a bust at some point in the future as a result of the overinvestment. And now we get to the third mandate, moderate long-term interest rates. You might notice right now that every single one of these is very subjective and vague, left up to interpretation. What does stable prices mean? Oh, it means inflation. What does maximum employment mean? Well, it's not everybody. Are we going by the unemployment rate? Are we going by the job force? Are we going by job openings? And what does moderate long-term interest rates mean? What is moderate? Is that 2%? Is that 10%? They need to leave these vague so that they can just achieve their goals behind the scenes and nobody can look at them with any strict form of measurement to say, hey, you're not doing your job for us. You're actually doing it for them. But the reality is they need this mandate the most because It is what supports the other two. If inflation really starts to take off, eventually lenders notice. If you know there's a very high probability that inflation is going to be running at 10% for the next couple of years, you are not going to loan anybody money for 5%. You know you're going to be losing on that. And so in order to compensate yourself for that loss of purchasing power, you're going to loan money out at least 10%. That will be the baseline. But if the Federal Reserve has the power given to them by Congress to make sure long-term interest rates are what they call moderate, it means they have the ability to force interest rates back down, despite the fact that it pushes them negative. Bottom line is that all three mandates given to the Fed by Congress are there to support an endless stream of income for US government spending. That's it. That's the real reason the Federal Reserve exists. And as long-term interest rates on US government borrowing are inching higher and higher, threatening to break out and trigger global financial instability, you can bet your bottom dollar that at some point the line on this chart is about to reverse course, and probably very soon. In other words, the Federal Reserve is going to be forced to resume quantitative easing again. It's in their job description. Interest rates go too high, they have to buy those bonds to push those rates back lower. This also means that this bear market we are currently experiencing is living on borrowed time. It is a matter of when, not if, we see a rapid recovery. When the printing press turns back on, asset prices go through the sky. Now, I know you've probably been burned by trying to buy the dip before only to lose more money later on, but that's probably because you didn't know how to, number one, identify what stocks you should be buying, and number two, calculate what price you should be buying them at. So this time, don't make that mistake. If you don't know how to do that, I've created a bear market investing guide just for you. And it's only going to be on a crazy sale while the bear market is still here, because by the time the bear market's over and done with, it's going to be too late. So don't wait. Get it linked in the description below. As always, thanks so much for watching. Have a great day.